Welcome to Turning Hard Times into Good Times. I'm your host, Jay Taylor, and I like to remind you each and every week I'm also the author of a newsletter called Jay Taylor's Gold, Energy, and Tech Stocks. And my company, Taylor Hard Money Advisors, is in partnership with Chen Lin, who publishes What is Chen Buying, What is Chen Selling? And you can subscribe to both of those letters by going to miningstocks.com, or call our number in New York during normal work hours at 718-457-1426. While we are concerned about geopolitics and economics and all that, of closest concern to all of us, I'm sure, is how are our respective portfolios doing and where are they likely to go next? What markets are likely to do best next? And there, I'm very privileged to have with me once again Michael Oliver. Thanks for joining me, Michael.
Oh, great to be here, Jay.
Always good to have you here. And the website that we use should all go to is olivermsa.com, olivermsa.com, to learn more about Michael Oliver and his work. Michael, you talked last year, about this time perhaps, or maybe even earlier, about a major tectonic shift in the financial market. Specifically, stocks and bonds, you were suggesting were nearing their top and were likely to head lower, and precious metals and commodities in general likely to head higher. How is that call working out now? And I noticed you headed this last weekend's newsletter that you sent out to your subscribers, The Great Unwinding, but how are things unfolding? Are they going pretty much according to the way you viewed them a year ago or so?
Yes. The risk here is, I think, the unwinding torpedo, let's call it the cause effect of the unwinding, is going to be, in my opinion, an upsurge in commodity prices. I realize that most people are now fully bearish, complacently bearish on commodities, fretting over it, in fact, central banks and so forth. And that's the headline. There's no idea that commodities could actually surge a significant percent. The assumption would be among most fundamentalists that you need a rise in demand to take oil up off its low and copper and so forth and so on. As an ex-commodity guy from the mid-1970s through the 90s, I learned early on that first phases of bull markets are often the unwinding of the excess of the prior bear market. In other words, the prior bear market went too low, too deep, too long. This applies to stocks and commodities in most markets. Well, commodities were driven off the page, particularly oil. It was 147 in 2008. It was lingered either side of 100 between 2011 and 14, and then suddenly goes to near 26. Explain to me how that's not excessive. I'm expecting a rally in oil and a commensurate rally in other across-the-board commodity markets up to about $60 in oil. If we close out the month or any month this quarter at 41.20 or higher, and right now we're trading that level, but it's not the end of the month. The next contract that comes on is the June, comes on Wednesday morning. It's up above 42 right now. If oil breaks out, natural gas breaks out, gold and silver already have, soybeans and corn are in the process, sugar already has, cotton is threatening. I go down the list and I see an across-the-board ambush in the making. The structures that I see that are being broken out above, they're not price chart phenomenon, they're momentum structures of a fairly long-term nature, quarterly momentum. Some of these structures are year to wide bases in momentum action. When you break through things like that, you get bottle rocket effects. So I'm expecting what you can call not a slow upside, but a rapid upside ventilation of some of these oversold markets. The fact that it's coming in unison, or probably across the board, will mean that those analysts who pay attention to commodity-type metrics, and to the extent that those metrics filter into the government metrics, we're going to get more than what the central banks have claimed as their policy a goal of 2% inflation. They're going to get ambushed, and they're going to get rates increase higher than that. Well, what does that do to their intellectual argument? In other words, how can they keep rates at zero or negative if they got their goal?
Yeah.
It unwinds them. Therefore, I would turn my focus right now on the commodities for the breakout, which is in process of occurring in my view. And the next, I would turn my attention not to stocks, because I regard stocks, basically developed market stock indexes, as secondary or pimples on the body of the debt market, government debt market. I'm not talking high yield now. I'm talking the safe stuff. I'm talking 30-year Treasury bonds, 10-year notes, German bonds, etc. I'm watching very closely the action of those markets, because what I see there is that if the commodity markets rally as I expect, you could undo those debt markets. You could rip them out of the hands of the central banks, and you could raise rates on these long-term government debt instruments. Now, I think we all know what that would do to the stock market.
Oh my goodness, that is frightening. And to think of it, of course, the bond market's far, far larger than the stock markets, but we start to see the safest, quote unquote, safest debt instruments in the world start to go down in value, rise in yields. It's going to be not a very happy event. Michael, of course, that's why I want to own gold, because it's a reverse play. It's a safe, it's the opposite of the dollar. With just a minute or so left here, you had talked about some very critical levels for the dollar index as well. Now, I'm looking at the dollar index, not at this moment, but earlier in the day. It was 93.98. How is the dollar looking? Does it look like that is one that's it's in the process of reversing, topping out now?
Yes, I think it probably has, but I'll tell you what, I think I take the dollar index and put it in the back, put it off to the side. It's a heavily weighted, 57% is the euro.
Yeah.
Therefore, focus entirely on the euro futures. Euro futures are right now around $1.14. If you can close out any week in the very upper 114s, they call it 114.80, let's say. I've had that number in reports in recent weeks. You close out a week there, I think the euro is going to join in big time. Now, the yen has already had a significant advance, but the yen is only 13 or 15% of the dollar index, so the euro really is key here. If the euro can launch, and by launch I mean you got upper 114s, I think you could see it in the low 120s within several quarters. That would be extremely upsetting to the dollar. And I actually think there's an intent by central banks to have that happen.
Yeah.
I think they want the dollar to weaken, and you've explained that in your last weekend report, in fact, with one of your guests, I believe.
Yes, that's correct. That's correct. The need to reduce, to lower the value of the Chinese yuan. But, yes. Michael, with just a few seconds left, I have to ask you about gold. You were looking at sort of your first major resistance area in a renewed bull market in gold of something around 1450, I think. Is that still a number you're looking at?
I still stick with that. There's been a lot of congestion here for 2 months, and I think it's all it is congestion. And I think that the first major barrier, and I don't think it stops it, but I think it's a hiccup point of significance, is way up there, 1450. Now, you can only take a guess. I can do it. Where would GDX be at that point?
Yeah.
I think GDX might be in the upper 30s.
Well, we've seen quite a lot of leverage already, tremendous leverage already in the mining shares relative to the metals, which are up very nicely, one of the best quarters ever in history, first quarters of the year.
It's the best place to be this year, and it's been our view all along that while gold turns, it's the gold miners that should beat everything on the board by large percentages.
Well, that's been your view, Michael. I must say, a year ago or so, you've seen this coming. It is indeed coming to pass now. Again, folks, it's OliverMSA.com, OliverMSA.com. Go there to learn more about Michael's work and hopefully pick up a subscription, because if you can afford it, it's certainly well worth it, I think. Very good money, a very good value for the money, I would say. And, of course, that's why we like to have Michael on, because I treasure his opinions and his work very much. Thanks for being with me again, Michael, and look forward to do it again hopefully next week.
Thank you, Jay.